Cramer, welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make a little money. My job is not just to entertain, but to educate you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. They don't start big, but we're beginning to see deals, important ones, and they aren't getting enough attention from the market or from the media, for that matter. If anything, on the eve of the unofficial start to earnings season, they're being dismissed, and that's just plain stupid. I even saw a downgrade today of Goldman Sachs, the principal deal house, and I almost have to laugh about how wrong-headed that is. Sell. Oh, and let's not forget, these mergers aren't just good news for the investment banks. They're good news for the entire stock market, which may be sensing something because we started the day down big and then rebounded with the Dow closing up 88 points. This will be advancing 0.14%, and the Nasdaq gaining 0.27%. You know what? It's actually a stupendous comeback, especially in light of some of the incredibly aggressive, some would say negative, tariff news from the president this weekend. Everywhere I went, people said, oh, boy, I guess the market's going to be down big on Monday. I said, no, not so fast. Regular viewers know that I think we have two markets here. Big institutional investors, they've generally been selling, but individual investors have been buying stocks hand over fist. I don't think they seem to care about the tariffs. They know that everybody sold after the Liberation Day announcements, and anyone who did, it turned out to be a big mistake. They missed a big move. But don't be so short-sighted. We're seeing the beginnings of an M&A boom here, even as it may not feel like it, because often the deals seem, well, dowdy or, let's say, not clear yet or in the future. I mean, you're going to see on Kraft Heinz. It's reportedly breaking up soon. People are yawning. So what? They're saying big deal. I say, no, that is dead wrong. The company said to be planning to keep its faster-growing brands, like maybe Heinz Ketchup, a lot of new derivatives there, Kraft Mac and Cheese, Philadelphia Cream Cheese, while separating the brands with the slowest growth, like Oscar Mayer Packaged Foods, Velveeta Cheese. The deal putting Heinz and Kraft together sounded like a match made in heaven in 2015. How could it fail? Great name brands, orchestrated by Warren Buffett and the brilliant people from 3G Capital, the uber-successful Brazilian private equity firm. It felt like the center of the store blockbuster. But then people stopped going to the center aisles at the supermarket, and that spelled trouble for Oscar Mayer, for Jell-O, for Miracle Whip, for Maxwell's, for Velveeta, which apparently can survive thermonuclear war, and Cheese Whiz of Whiz Wit fame if you go to Geno's in Philly, which remains my go-to place when I head to the city of brotherly love. Here's what's amazing, though. People now think these brands have no value. But you know what? That's what they said about W.K. Kellogg, the cereal business, when it split with Kellanova, the fast-growing part of the Kellogg family, which, of course, got a bid. Until the cereal acquirer couldn't resist, C-E-R-E-A-L-N, yes, S-E-R-I-A-L, cereal acquirer Ferraro stepped up and paid $3.1 billion for the maker of Fruit Loops and Corn Flakes. That was some deal last week. It was amazing. Sure, it's supposed to be a nightmare in a world where Health and Human Services Secretary RFK Jr. is on a crusade against food coloring, but it was a dream come true for Ferraro, which has spent $13 billion in 10 years to expand around the globe. They don't want to be just a small Italian company. My feeling is that if Giovanni Ferraro sees value in Fruit Loops, he might see some value in some of the Kraft Heinz brands, too. Or consider Kenvue. 2 years ago, this company was spun off by Johnson & Johnson, which wanted to unload its fantastic consumer business. Think like Tylenol, Neutrogena, Listerine, Aveeno, Sudafed, Pepcid, Band-Aids, Zyrtec, and so many others all under one roof. The company picked this fellow, Thibaut Mongon. He was the leader of J&J's Consumer Health Division to run it. We learned today that he was sacked after activist pressure, and Kirk Perry, a current director, was named interim CEO. Kenvue also announced a strategic review of its brand stable. That's what we're hoping will happen at Kraft Heinz. Is this shocking? Was it amazing that Kenvue already got rid of the CEO in 2 years? Well, yes, if you saw the numbers. Kenvue reported minus 4% organic growth when Wall Street was expecting plus 2 to 4%. But I bring this up because more deals are coming in that space. Any one of the majors would be thrilled to snap up some of these brands because there's very little organic growth in the industry. The only way you can have any growth is buy it. All right, now how about this merger today between Becton Dickinson, this was the Life Science and Diagnostic Division, which had been shopped extensively, and Waters, a really strong company. We've had them on, a dominant player in exactly those fields. The deal was done in a very confusing reverse Morris Trust way, which is one of those tax-saving situations that the street almost always hates, but the CEOs think is so smart. And they hate it because they aren't easy. They're not clean. The merger was greeted with horrors for Waters, which saw its stock plunge 13.5%. That's part of the greeting. It shouldn't have been down that much, but people didn't understand it. Becton Dickinson's getting a 39.2% stake in the newly combined Waters, yet after selling off this morning, its stock actually finished in the black. Seemed like a great deal to me. especially because the company got $4 billion in cash and assumed $4 billion in debt. Really good deal for Becton Dickinson. But again, it's hard to get your head around, so it didn't bring out many buyers, at least not today. Believe me, that will change, and people say that not everyone lost. Oh, by the way, big winners included Barclays, which represented Waters, and Citi worked with Becton Dickinson in a $17 billion transaction. They made out like bandits. Or how about one of tonight's guests, Huntington Bank shares, which announced today it was buying Veritex. I thought it was a tech company. No, it's a Dallas-based bank for $1.9 billion. I know not huge, but it puts Huntington in the queue to shed its regional status, become much more of a national bank, at least in the parts of the nation that are good for business. CEO Steve Steinhauer says that Veritex will help his Ohio-based bank move into a number of cities in Texas, which is one of the great growth states in the union. I think this is the kind of deal we'll start to see more and more of now that we have a new banking regulatory regimen and antitrust authorities that won't reflexively block acquisitions. We'll talk to Steve Steinhauer later in the show about how this acquisition fits into Huntington's aggressive long-term plans. In the end, what matters is that deals are getting done, even if they're sometimes being done at prices that people don't like the Waters deal. I'm extremely confident that someone will want some of Kenvue, if not all of Kenvue, because those brands grow slowly. But if you put a bunch of them together, you might have something that Wall Street gets very excited about. And again, it's not just about the takeover targets. These M&A deals are incredibly lucrative for the banks that orchestrate them. The results won't necessarily be seen this quarter. So I can see why Citizens JMP, a brokerage house, might take Goldman Sachs from buy to hold. Goldman reports Wednesday, and you won't see the bump in numbers from the deal market yet. However, these heart of July deals are a terrific harbinger for the fall. You don't usually get a lot of deals during the summer. And I don't think it makes sense to sell Goldman here and then try to get back in it later. Good luck. Even if they miss the quarter on Wednesday, it's not going to stay down for long. I'm clearly not alone, as the stock actually rallied more than $8 today, despite this downgrade. Here's the bottom line. You don't get a wave of deals out of nowhere. You get a ripple and then ever bigger waves. Right now, we're in the ripple stage. That's when it's best to do some buying. By the way, even if you think brands like Maxwell House and Visine and Corn Pops died years ago, don't worry about it. They may not be exciting to you, but there are plenty of potential buyers who are excited about that. We'd be happy to snap them up, and the regulators are no longer blocking every M&A deal under the sun. As we head into the bank earnings tomorrow, don't think about the past with Washington leaning against every deal. Think about the future, where it looks like the government is encouraging deals and is no mood to get in the way of capitalism, at least the way we used to know it. Let's go to Rick in Oklahoma. Rick.
Booyah, Jim.
Booyah, Rick. What's up?
Been a club member for about 2 years.
Oh, excellent. Hello?
First-time caller, and thanks for all you do.
Oh, thank you. It's been a tough, just working around the clock right now, it seems, but I'm glad you liked it. Thank you so much. How can I help you?
Have a very, very fast shout-out to the OKC Thunder for winning the NBA championship.
Absolutely. They did a good job. Okay.
I have a few hundred shares of Wynn stock.
I think Wynn, we were at Wynn earlier this year, and I was very worried about China. I still am, but they've got a good thing going. Craig Billings is such a good manager. He's actually terrific, and I'm glad to see that stock is finally starting to move. It's still very inexpensive on a PE basis. How about we go to Jay in Washington? Jay.
Hey, Jimbo, how's it going?
Not bad, Jay. How about you?
I'm doing excellent, thank you. Hey, I'm a longtime listener and charter club member. Thanks for helping me retire early.
There you go. That's, as I told Casey Sullivan, our boss, we are changing people's lives. It's different from compensation that you're used to with dollars. It's a different kind of compensation. I like it more. How can I help you?
I used to work hard for my money. Now my money's working hard for me. In January, I started building a large position in this best-of-breed company. Now I'm in the house of pain. I agree that it doesn't matter where stock's been. It's about where it's going. Right. And I don't think this company is going to meet earnings expectations later this month and will keep falling. Anyway, I want to sell half my position now and the rest into any strength before earnings. Maybe invest the proceeds in one of my growth stocks.
Okay.
This stock's flatlined and looks like dead money. What are your thoughts on United Health?
You know what? United Health is very, very tricky, and it might be a long-term turn. But I will tell you this, Steve Hemsley is the only person I know who could possibly turn this thing around. Hemsley's back as CEO. He was amazing. I think you have to have fortitude to be in it. I don't like the situation because there's so many winners, as you say. But at least I want people to know that I think Hemsley's the real deal. All right, look, you don't get a wave of deals out of nowhere. And now we're starting to see something happen. I think it's a sign that you got to do some buying. Look at the dip today. It was such a great opportunity. Again, Mad Money tonight. It's 1 year since CrowdStrike's outage took down millions of PCs worldwide. And I'm sitting down with the company's bankable CEO to dig into their incredible recovery efforts. Then Zimmer Biomet announced an acquisition this morning that will strengthen its robotic surgery portfolio. I mentioned a couple of acquisitions, not this one too small, but I'm hearing about robots in the future and what they're going to do because that company's not growing fast enough. And I think this might accelerate it. And it's steel season. As I've said, Huntington Bank shares are snapping up Texas-based Veritex. What does it mean for the Lone Star State? What does it mean for the Buckeye State? What's it mean for your money? I'm going one-on-one with Huntington's top brass to break it all down. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
It's hard to believe that it's been almost a year since CrowdStrike, the cybersecurity play that we own for the Charitable Trust, accidentally caused widespread computer outages with a fully file update, not a hack, a file update that sent millions of systems offline, halting businesses across the globe. Now, fast forward today, though, and it's like the outage never happened. Not only is CrowdStrike's stock up more than 135% from its post-outage lows, it's up almost 40% from where it was trading before the outage. That's because cybersecurity is essential, and this particular cybersecurity firm is incredibly well run and loved in the industry. I've never seen such a rapid executed turnaround. Can it keep running? Let's take a closer look with George Kurtz, the bankable founder and CEO of CrowdStrike. Mr. Kurtz, welcome back to Mad Money.
Great to be here, Jim.
George, I know this was an event that you took head on. Not only did you not hide, but you went out and told everybody everything. Could you give us a bit of a minute by minute of what happened and how you swung into action?
Well, as you recall, Jim, you were on vacation that Friday, and I had to get you out of bed or whatever you were doing to get it on the line to get in front of this and talk to the public, talk to people. Obviously, a big part of our success at CrowdStrike has been transparency and accountability, right? And there was an issue with a configuration file that caused the outage. We were able to revert it back, and then the work began to help customers recover. But the first thing that we wanted to do was to make sure everyone knew what happened and what we're going to do about it to make it right.
You know, it's funny. People regard you as a PR mastermind. I don't think it's true. I think where you are was someone who just said, here's what I'm going to do. I'm going to do it. Get ready. I'm sorry. Let's move. And that's not PR. That's just action.
It was, Jim. You know, you think about that day, which I certainly remember, and I'm sure you do as well, as, you know, not many CEOs are going to just run on TV and talk about this, right? They're going to consult their lawyers and PR firms and everything else. And for me, it was important to make sure that we explained what happened, that we took accountability for it, and told people how we're going to fix it and work with all of our customers, which has paid, I believe, dividends. You know, our customers love us. We have more customers because of the ability to be transparent. And yeah, we had a glitch, we fixed it, but given what we've talked about and what we put out on the 1 year anniversary, just an update of all the changes that we've made and all the resiliency that we've built in and all the safeguards. It's been an incredible journey with our customers and partners and lots of people who pitched in. So I think we just tried to do the right thing and always keep the North Star as the customer is always in focus for us and do it right by the customer.
Well, I saw you in Italy. You were at that point on your tour. I mean, it wasn't like it was an apology tour. What can I say? And did everybody agree to see you that you called, or were there some people who said, listen, don't bother, I don't want to see you ever again?
You know, for the most part, we were able to, talk to or see customers that wanted to see us. They understand that things happen. And in fact, there are many customers, you know, we went through what happened and why it happened and why it won't happen again. But they sort of, you know, chuckled at the end and said, you know, they break more things than anyone else when they change their own system. So they were a bit understanding, and they realized that these sort of things can happen. But from my perspective, you know, I think it was a great to get in front of these customers, to meet with them. And, you know, they want to see people. They,
Right. They don't want.
they want to actually.
They don't want you hiding.
Yeah, they want to see people. Yeah.
Now, I was kind of disturbed by there were cyber spending cuts in this most recent in the big beautiful bill, a 1.2 billion cut in cyber spending, 10% drop. How could anyone ever think they can get away with that? I mean, the federal government is being hacked every second.
Well, when I think about the federal government or any governments in general, they're certainly under cost pressure. And what CrowdStrike has been able to do with its platform strategy is reduce overall costs, reduce overall complexity, reduce the number of agents or the pieces of software that are running in an environment, and give them better outcomes. So I think for the first time, you see the federal government really focused on running itself like a business and trying to drive cost and complexity out of it. With our AI technology in Charlotte, with the ability to consolidate, with the ability to understand from an intelligence perspective what these nation states are actually doing, I think it actually is going to play into our favor long term.
I was thinking about transparency and thinking about the idea that you have to own up about what happens. And I was surprised to see, I know Delta sued you, and I was looking at their annual report, and they said, this is February 25 annual report, the airline claimed it not experienced any material cybersecurity incidents over the past 3 years, reported only immaterial cybersecurity expenses. I mean, it's almost as if until the clients own up that they got hurt, I think people can say, you know what, I can get away with this. I'm not gonna put any money in this.
Well, I mean, that's the thing. When you look at these sort of cyber issues that are out there, we respond to, I don't know, probably more than 50% of the large breaches that are out there, helping customers actually recover from them, and then generally they become customers. But a lot of times you'll see a lack of investment in cybersecurity until something bad happens. And I think that's one of those areas when you look at the secular trends around security, security's up sometimes in the market, security's down. But at the end of the day, security and technology are always going to advance forward. The technology change is just too rapid, and all of these technologies are going to need security. So from a secular perspective, we think it's a great place to be. And, companies are going to need more and more security as the attacks continue to be more and more sophisticated.
Now, we keep hearing about Jason Wong talking about that the machines will be able to reason and reason really well. Right now, you get a right prompt and you get it right. All right, when the machines can reason, won't they figure out how to get into anybody? If the bad guys can program it.
Well, that's the hard part right now. When you think about how fast AI is moving, it's hard part, but it's also an opportunity. Like the bad guys are moving much faster, and there's always this time element of security. Obviously, you want to prevent as much as you can, but if there's an incident, you want to be able to identify it very quickly and then be able to remediate it. And with AI, it really democratizes how many more adversaries are out there, even with limited skill sets. So from that standpoint, the threat environment continues to evolve. It continues to get faster. But on the same side, the defenders like CrowdStrike, who have used AI since I started the company, it was machine learning, now it's Gen AI, are able to also combat what these adversaries are doing. So you've got to use AI to protect customers, and you also have to use AI to protect AI. And at the end of the day, we think we're in a fantastic spot. We think we're in a leader in that position with our Charlotte AI technology.
Well, I know when I read people like Dan Ives, who's one of my favorite, who just says, listen, you are the gold standard. I couldn't agree more. Last question I have is, I speak to a lot of people who've been hacked. They don't want to talk about it. I get that. This is pre when you have to disclose it, but also post. And they all say the same thing, which is like, I got this call from George Kurtz. You want to know if he could do anything to help. But you weren't there. They weren't paying you. You do that.
Yeah, we do that all the time. I mean, obviously I have relationships in the industry, but even without a relationship, we try to help all the time, whether it's a customer, non-customer. A lot of times what we'll see when we investigate something is we'll see an ancillary intrusion into another company, and they may not be a customer of ours. So we'll routinely call them up and basically say, hey, look, we think we saw something. We're happy to help. If you have other service providers, work with them, but we're there to help. And at the end of the day, security really is a community effort. And it really comes down to the people in security. It comes down certainly to technology, but you have to use the collective community to be able to protect everyone else. And we want to be good stewards of this information and help out as many people as we can.
Well, I think it works because your competitors all said the same thing to me, which is I have nothing but good things to say when the outage occurred. Of course, I was looking for a story about, well, what is this? How did this happen? They all said, no, by the grace of God, because they know how hard you work and how good your company is. Last question. Look, we bombed Iran. We're talking about going hard against Russia. The Cold War with China doesn't seem very cold. Seems very warm. And so what does the geopolitical situation look like?
Whenever there's geopolitical tensions, the cyber attacks go up. We've seen it. We've seen wiper malware, that's destructive malware. We've seen intrusions into critical areas that are focused on really understanding, the lay of the landscape and what's happening in the governments around the world, right, as things move. So that geopolitical tension really does drive additional security needs. And as I said, it's only going to get worse as AI now comes into play. And as the adversaries and even nation states leverage more and more AI, create this sort of virtual army of agents that can attack other countries, you just have to be on your game. And I think it's a great opportunity for CrowdStrike, certainly where we are today and the long-term opportunity to get to our goal of 10 billion.
Well, thank you, George. And everyone should know George is very transparent. You can go back and read this. One day it'll just be a case study and we'll know. But when something goes wrong, you go the George way. You don't do anything else. George Kurtz is founder and CEO of CrowdStrike. I always love having you on, George. Thank you.
Thank you, Jim.
Mad Money's back after the break.
Coming up, as pickleball injuries rise, Cramer's eyeing one company poised to cash in on America's fastest growing sport. Next.
Baby merger Mondays are back. We got some sizable deals today across a bunch of different industries and some smaller ones too. Like Zimmer Biomet, the medical device maker, announcing its plan to pay nearly $200 million up front for Monogram Technologies, an orthopedics robot company with a set of semi-autonomous and fully autonomous robotic technologies that will be used to improve Zimmer's main robotics platform called ROSA Robotics. I like this because the robotic surgery space is one of the most interesting corners of the healthcare sector. Still, what's Zimmer actually getting with this deal, and is it enough to get investors excited about a stock that's been more or less range-bound for years? Let's talk about it with Ivan Tornos. He's the chairman, president, and CEO of Zimmer Biomet. Mr. Tornos, welcome back to Mad Money.
Great to be back, Jim. Always a lot of fun to be in your show.
Oh, thank you. So, Ivan, I need to get a sense of what you really get with this company, because I looked at it, it's kind of pre-revenue, hasn't really done much, but at the same time, it seems to have very good technology.
It's a good day in healthcare, and it's a bold move. Through this acquisition, Zimmer Biomet, the number one company already today in hip and knee replacement, will have a fast pathway to become the only company that can do semi-autonomous robotics and fully autonomous robotics. So it's a bold move, and yes, we're going to have to wait for the revenue, but it's going to be very compelling for patients and shareholders.
So you're able to slip this right into your suite immediately.
It's going to become one of the components of what is going to be the most comprehensive suite of solutions. We're going to have ROSA, as you mentioned, image-less robotics. We're going to have portable navigation, portable robotics. We're going to have mixed reality applications. And yes, we will have now the only, and I want to say that out loud, the only autonomous robot that can do more than executing surgical tasks. It can control and understand the entire surgery. So it's breadth of portfolio, category leadership, and more patient and customer choices.
So just tell me, if I'm a shareholder of Monogram, you've got a very interesting structure, this the CVR, which seems like to me might be a good thing to have.
It makes a lot of sense for patients. It makes a lot of sense for shareholders. This deal is EPS neutral right away from 2025 through 2027, and it's accretive after that. We generate revenue starting in 2027. And to your point, the CVR makes a lot of sense. The enterprise value of this acquisition is about $168 million, and we pay as we go. And I hope we do end up paying everything with these earnouts, because that will mean Zimmer Biomet really driving market share in a very meaningful way over the next 5 years.
Right, so
again, I hope we end up paying every
I
milestone.
think that's a very positive attitude. It could be. Now, Ivan, tell me what's going on right now in this market, because I look at Stryker, I look at you guys. I mean, you're really an incredibly high-tech company, so Stryker. And yet your price-earnings multiples are lower than I think they should be. What would it take to get the kind of multiple expansion that you and I both know you should be getting, given how high-tech you really are?
Okay, look, listen, the stock has been challenged in the past for some challenges, and there is short-term uncertainty.
Right.
But what it is certain is that technology that solves meaningful problems for customers and patients, at some point will get rewarded. So, Jim, I don't think it's any more complex than giving it some time and proving every quarter that all this innovation that we're acquiring really, truly changes the standard of care in the way that Monogram technology will change the standard of care. So let's give it some time.
All right, so give me a sense of baby boomers, what they're doing, and millennials, what they're doing. And we play pickle with your pickle paddles, and we know that people who haven't had, who are just doing kind of non-impact exercise or suddenly doing impact exercise, they're part of the people who suddenly get hurt. I know so many people are getting new knees. It's anecdotal. I know new hips. My wife's getting a new knee, so I'm really focused on this. And it just seems like it's like an epidemic of use. What are you seeing out there?
We love pickable players like you and your wife. We love people that are mobile. We're in the business of restoring mobility, and we've been doing since 1927. Today, 1 of every 3 primary care visits here in the U.S. is a patient with some sort of arthritis issue. And look, there are 600 million patients on Earth that should be going to see those primary care doctors, and most of them are not doing that. We're getting older. We're getting more mobile. We want to get a better lifestyle. We want to be young again, and technology like robotics, like smart implants, like best-in-class knee and hip products, like the ones we've been commercializing since 1927, gets you back on that pickleball court. So we are busy, but I think we're going to get busier.
All right, one last question, Ivan. How about holding costs down? Does it hold costs down if you have the full suite, soup to nuts?
The most important element of cost is reducing the time in the hospital, reducing the time in surgery, making sure that readmissions don't come back. Efficiency in one word. And smart technology like Monogram technology drives efficiency and best-in-class outcomes. That means you're getting back to the pickleball court sooner. That means you're not spending time in the hospital. That means you potentially can do your surgery in an ASC, ambulatory surgical center. So yes, efficiency does reduce costs.
Well, look, congratulations on the deal. Everybody wants this stuff to be as robotic and as efficient as possible. Thank you, Ivan Tornos. He's the chairman, president, and CEO of Zimmer Biomet. Good to have you on the show again, sir. Thank you.
Thank you, Jim. Appreciate the time.
Yeah, money back if friend.
Coming up, everything's bigger in Texas, including Huntington Bank shares footprint after today's acquisition. Cramer talks to the CEO about its $1.9 billion deal. Next.
This one, we got a real bank merger. One of my favorites, Huntington Bank shares, the Ohio-based regional bank, now is buying the Texas-based regional bank Veritex in an all-stock deal that values the target at just under $2 billion. Now, the grand scheme of things, this is a small transaction. I didn't even know Veritex, but it helps Huntington grow in Texas, a market where it was already expanding aggressively. Plus, the company also pre-announced most of the key lines of its second quarter earnings report, but due Friday, the numbers look pretty darn good. When you back out some one-time items, Huntington posted solid earnings with better-than-expected net interest income and fine-looking credit quality metrics. So let's dig deeper with Steve Steiner, who's the chairman, president, and CEO of Huntington Bank shares. Get a better read of the situation. Mr. Steiner, welcome back to Mad Money.
Jim, great to be with you again. Thank you.
Okay, so Steve, let's talk about why you want to expand in Texas, how good that market is, and why Veritex is the right partner.
Well, Jim, as you know, we're very large in the Midwest, and as we look to diversify our earnings and revenue capabilities throughout high growth areas, Texas is a logical next expansion for us. We've been there since 2009. We've had great growth and success, and we've got $5.6 billion in loans outstanding. We'll cross $6 billion this year anyway. We've got a couple hundred employees in Texas. We call them colleagues. And so we're familiar with it. Texas itself is an economic powerhouse, and we're very excited to be going there with Veritex, a great organization.
It's interesting in the conference call, Steve. I thought it was very poignant when you said, look, they have an incredible story. It's a very different story from most of the banks you deal with. And they even had this fellow, Malcolm Holland, who I imagine must be some incredible entrepreneur that a lot of people want to do business with, and he's staying on.
He is. And think about this. He started the bank in 2010. Remember how tough it was then. And they have just been on a roll since. Malcolm is an important leader for us going forward. We partner well with banks like we did with TCF 4 years ago. And that has proven to be a home run opportunity, a combination that has delivered fantastic results. We're very optimistic about doing the same with Malcolm and his team at Veritex.
Now, it looked like under the Biden administration, unless a bank was failing, you really couldn't get in doing anything. This seems like a fresh new page here. You got a very profitable bank in Veritex, profitable bank in Huntington Bank shares. No one, the regulators don't seem to mind that at all, do they?
Well, there's a more constructive overall business tone, not just in banking, and we are clearly benefiting from the constructive tone in our sector, and it's reflected in the approach this still came together in 4 weeks, Jim.
Jeez.
It's a record for us, and we have done an exhaustive due diligence. We're very confident in our outcome, and we've had huge success in integrating in the past.
Well, when I look at your expansion plans, it seems like that you've really, you could say, well, hold it, did they skip over places? I would say, no, you're in all the places that seem to be pro-business.
Yes. On purpose. And Texas is one of those that's best in the world in terms of pro-business. We love what we're doing in North and South Carolina as well. So we're in 3 of the fastest growing 5 states in the U.S. now in a major way.
So tell me about when you looked at the quarter, you felt like you could pre-announce it. To me, it looked very solid, which leads me to believe that all the worries that we might have had about a slowdown in the regions that you're in just didn't happen. I mean, business is strong in the country.
It's a great quarter for us. We were having such a good quarter. We took about a 4-cent one time just to move some securities off the balance sheet, and we still met consensus. So we had if you do an add back, we had a 16% beat. It was a sensational quarter. Credit was outstanding, 20 basis points of charge-offs. Revenue expanded, NIM, net interest income by 3%. NIM expanded, capital grew. It literally hit on all cylinders for us.
Do you think we're done with that securities repositioning? I saw that and I said, oh boy, I don't know. I don't want to see that to be the start of something like that.
Well, we've only done one in the since interest rates started moving up 4 years ago. It happened to be this quarter. And in part, it was a reflection of just some level of uncertainty about where longer rates are going to go with the discussions around tariffs. So we thought it was a good de-risking move at the right time, and we had plenty of capacity to do it.
No,
we don't anticipate another.
Okay, when I read through your financials, I said to myself, I would not necessarily call the Fed chief too late pal. I mean, to me, he's looking at some parts of the economy that are very, very strong. Doesn't want to make the wrong move. I know that in a less political time, I think people would just say he's being prudent.
Well, we saw this in the early 1980s when there was a double dip. The Fed increased rates significantly, but the inflation they provided relief too quickly. Inflation returned, and then rates really shot up to the roof. That was when prime was 21%. So I think there's a prudence in this action, but we now have the big, beautiful bill passed, so we know what taxes are. If we get through the tariff uncertainties, which looks like it's going to be another month or two, I think the underlying economy is in good shape. Oh. And we're seeing that in the credit quality. And I think the industry will have good credit quality this quarter.
Well, you mentioned the big, beautiful bill. I'm going to ask you, you're a banker and you're really smart about these things. I deal with a lot of people who are not who are rich, but are not all that sophisticated about the different changes that were made in the big, beautiful bill. There are elements of depreciation and elements of R&D credits that could unleash trillions of dollars in spending, and no one believes me.
Oh, I'm on your page. I think the accelerated depreciation will be a huge boost to the onshore manufacturing and other expansions that companies are looking to do in the U.S. And so we're the 4th or 5th largest equipment financer in the country. We love this provision. We think it's going to be very significant to economic activity in 26 and beyond.
Now, are your bankers making that call? Are you telling people, look, this could be a great opportunity to expand?
We are. It's reflected in the investment with Veritex. We grew loans 8% on average over this past year. So as we said last August on the show with you, we think we can be part of the economic equation, a part of the solution set to grow the economy. And we're certainly doing more than our part. We're peer leading.
Now, do you want to be in all states, or do you just want to be in the states that are very that like to grow and don't like to punish business?
We're targeting higher growth, pro-business states. And that's why the entry into North and South Carolina several years ago, it's gone hugely successful. And the growth we have in Texas that we've built over time, really like and understand that market. And we are thrilled to have Malcolm and team join us from Veritex. Texans like to do business with Texans. And we have one of the great businessmen in Texas joining us.
What I'm not hearing from you is that, look, I'm really concerned about the tariffs. The tariffs are putting a lot of people on hold. It could really cause a lot of inflation. This is a frightening time. I'm not hearing any of that stuff from you.
Well, I believe there is an impact with the uncertainties of tariffs. Having said that, the core economy is really performing well. And it's showing up in terms of credit quality. It's showing up in terms of, for us, loan growth. And so we're optimistic about it. You still have very low unemployment levels by historic standards. So this feels like once we get a few of the issues settled, and they're getting resolved, the last one, big one, I think, is tariffs. The economy is going to rebound a bit, and we're going to see economic growth at important levels.
I totally share that view. I just really think that people have to recognize as long as there's unemployment that is low, that's the secret of our great country. And you got it dead right. I think your plans are terrific. Steve Steiner, he's the president and CEO, chairman of Huntington Bank. We championed this thing right through the 23 crisis, the whole thing. It's just been a great stock to be in. Mad Money's back after the break. It is time to have the lightning round. Crazy Wednesday. Back to numbers. Same the stock. Buy, sell, subject to another core stock. Which is that might say through the way. Play this out. And then the lightning round is over. Are you ready, Ski? Time for the lightning round. Cramer says, let's go to Charles in Tennessee. Charles.
Hey, big Harvard Crimson grad student, booyah to you.
Oh, yeah. Well, those are the days. Those were the days. Man, I didn't sleep on
right
Tuesdays
now.
then. Okay, you're there now?
I go back and forth. Yeah.
Good for you. Good for you.
I fly back and forth.
All right.
Anyhow,
excellent. Okay.
ODP, Office Depot.
Yeah, but, you got to look at the away from the U.S. to understand why ODP actually could be an okay situation. I'm not going to fight a 6 times earning stock as long as it's making money. I think you're okay. It's an interesting spec. Let's go to Brett in California. Brett.
Jim, Brett from California. Palo Alto, is it good to buy at this level?
I want to live at Palo Alto, and I want to own the stock of Palo Alto. That's how I feel about it. Nikesh Arora doing a fabulous job. Can you imagine Kurtz and Jay Chaudhry, too? This industry attracts a lot of real smart people. Let's go to Nicole in California. Nicole.
Jim, thank you so much for taking my call.
Of course.
My question, thank you. My question is, healthcare just seems like a slippery slope, but we all need it. Tell me, if it's not this one, what can I get? Nutex.
I don't know Nutex. I don't want to end on one that I don't know. Come on. Oh, darn it. Come on. And that, ladies and gentlemen, is the conclusion of the lightning round.
The lightning round is sponsored by Charles Schwab. Coming up, new week, new acronym. Cramer's got a fresh batch of stocks to watch and reveals the names next.
And the winner is Park, as in PARC, your money in these 4 stocks to stop worrying about tariffs, China, the Fed, pretty much anything else. Just enjoy the magic carpet ride. Buy. If you're a tape reader as I am, then you've noticed that you tend to see 4 stocks go by more than any others. Palantir, AppLovin, Robinhood, and Coinbase. Park. They're the meme stocks of this era, stocks that long ago kind of ceased to be stocks, at least in a traditional way. They now become chits in the great game that is the stock market. And they're moved up like the old GameStop through sheer force of buying from home gamers who refuse to sell. Except that unlike GameStop, these are all amazing growth companies. It's exciting to see how the meme people have figured it out. Buy the stocks of companies that are doing well and don't worry about how much you pay for them if they have great growth. There will always be someone who will want to pay more for growth. And they are right, because growth is the only safety in this market. That's why today I said I wanted to find an acronym for them, not to ridicule them, but actually because I enjoy them. I'm thrilled for them. I got to see that I wanted a consensus around these four insanely strong stocks and how they just don't have any quit in them. So Park has been born. There were others that people, let's just say now many people in my Twitter file chose to use a far less flattering anagram, embracing the same four letters in reverse order, perhaps because they don't understand how this game works. So let me tell you. First, all four of these companies are actually fabulous businesses, well-run, with dynamite financials, great leadership, even if their stocks have certainly rallied to gonzo levels. Palantir is among the fastest-growing tech companies I can recall. It's got a projected annual growth rate of 18 to 25% out to 2030, with a market capitalization of $352 billion. May not sound that impressive. 2 years ago, it was $35 billion. What does Palantir do? I say, what doesn't it do? You bring Palantir in to look at patterns to figure out how to run your business better. I've never heard anyone say that they aren't terrific at what they do, making your company money almost the minute you bring them in. They're also trying to make the Pentagon more efficient, but that's a tall order. I hope they succeed. So should you. AppLovin is a hugely profitable way for companies to advertise through mobile video games, which are typically free as long as you watch the ads. This company's got software and AI solutions that make its model unassailable. They have no real competition. The revenue growth is stunning. It was a $10 billion company 2 years ago. Now it's $120 billion, as this is the company that can get your ad in front of everyone who plays games on their phone. I know it's richly valued. I don't care. When you have no competition, well, guess what? You do pretty darn well. Do I have to describe Robinhood to you? It's an app. No, it's a bank. No, it's a repository of wealth of the millennials, whatever you want to call it. Robinhood has 25 million accounts, and it offers ETFs, options, gold, and crypto. It came out of nowhere. This company was worth $11 billion 2 years ago. Now it's $88 billion. Again, incredibly profitable. Out of nowhere. It seems to have captured young people who would otherwise not bother to invest. You know what I say? Hallelujah. Finally, Coinbase means crypto. 52 million Americans have kept their crypto there, part of 100 million users globally. It's the only crypto company in the S&P 500, so it's the perfect poster child for the group. Again, Coinbase, immensely profitable, and at 40 times earnings, it's actually the cheapest of the group. How can that be? All right, there you got it. It's Park. Now, why did I think of this? Because on Friday, we held our CNBC Investing Club annual meeting. It was a joyous event. We really lit it up. One individual wanted to know if we'd ever recommend speculative stocks. I said, we run a charitable trust. And while I approve of speculation, most people don't, I didn't feel it was in keeping with our mission. But I thought about it all weekend. I realized that I should just give you the list of stocks where it seems like if you enter a sell order and it was found out, they'd tar and feather you. Is there any valuation that would be too much to pay for Park? I can tell you from where I stand, absolutely not. The money is parked in these names. The buyers are insatiable. They are for speculation about as great a gift as you could possibly have, at least for now and probably for some time to come. Just remember to ring the register for some of it on the way up. Try to take out your cost basis, and then the ultimate thing you could do, play with the house's money. Oh, shh. I won't tell anyone that you sold it. I promise. I like to say there's always a bull market somewhere. I promise I'd fight it just for you right here on Mad Money. I'm Jim Cramer. I'm going to see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.